All right, good morning, everyone. I'd like to call this meeting of our ERSRI board, May 20th, 9:30 a.m. Andrew, can I please have a roll call?
Treasurer Diosa.
Here.
Mark Crulo is absent. Joe Codiga. Here. Matthew Howard. Here. Yen Lee.
Here.
Elena Mertens.
Here.
William Murray.
Here.
Andrew Nada. Here. Alan Palazzo.
Here.
Sandra Paquette.
Here.
Jean Rondeau. Here. Dr. Shaw Hughes.
Here.
Michael Tui is absent. Treasurer Webb Quorum.
Thank you, Andrew. I'll now seek the approval of the draft regular and executive session meeting minutes of April 8th, 2026.
So moved.
Second. All in favor, vote aye.
Aye.
All right. Motion has been approved. Andrew, on to you.
Great. For my report, this is something that would sometimes be an admin committee, but we're splitting Eugene's responsibility. I just want to introduce the actuaries so they can be up at the top of the meeting and we have plenty of time for discussion. You've all met Paul and Joe before. They're here to discuss the actuarial experience study, and I'm going to let them jump right in.
Right.
Good morning. Welcome.
Good morning, everyone. Roxanne's going to pull up our presentation for us. Here we go. Starting on slide 2, just want to talk a little bit about why we are here. This is a little bit different than you normally see us. Normally we're here in December. We're talking about the actuarial evaluation. Today we're going to talk about the experience study. Just everyone keep in the back of their mind that this experience study is simply to set the assumption for the defined benefit plan. And so we're going to talk about what that means here. Then Joe's going to walk us through the preliminary findings and go through some of the individual assumptions, the key assumptions that we're going to talk about investment return, wage assumptions, wage inflation, then turnover and some discussion on mortality. Well, and then finally, we'll wrap it up with looking at what we think the changes in these assumptions would do to the results. And so we're going to do an illustrated impact on the last evaluation that we performed. So on slide 3, as I mentioned, we're typically here for that valuation. The purpose of that valuation that we present in December, it's to set the contribution rates. And those contribution rates are effective 24 months after the valuation date. So we go through that exercise every single year and set those contribution rates. And the purpose of those contribution rates are to accumulate assets so that we have money on hand to pay benefits when they're due. We've made a lot of benefit promises to the employees and retirees across the state of Rhode Island, and that money is meant to be accumulated to pay those benefit obligations. And one of the goals that we have is to have a consistent pattern of contributions. So it certainly helps with budgeting. A lot of the contributions come from the state itself. And so the purpose of that evaluation is to set that pattern of contributions, and then also to set up policies and strategies so that those contributions can react to experience as it unfolds. On the next slide, so how do the assumptions factor into that particular evaluation? Well, first and foremost, the actual cost, the true cost of your benefits has nothing to do with the assumption whatsoever. The true cost for benefits is going to be based upon, well, what are the plan provisions, but what are the benefits that everyone is eligible for, and then what does actual behavior look like? And so that's before we even start thinking about setting any sort of assumptions. It's all going to be dictated by what is the actual behavior going to look like over time. And then furthermore, what are actual investment returns going to look like over time? The assumptions help us set up a reasonable starting point. We need somewhere to make a decision, something to make a decision based on. And so the assumptions are going to help us with that. And when we're doing this assumption setting process, a lot of it is very much so data driven. As we look at the experience, the determination experience, the mortality experience, all of that. But what we need to keep in mind is that these are forward-looking expectations. This is our best estimate of anticipated future experience. And so thankfully, Joe and I just aren't doing this on our own. We're just not making stuff up on the fly. We have some standards of practice that we do have to adhere to when it comes to things like data quality and data review. In fact, that's actual standards of practice number 23 that helps us determine what data is appropriate to use in a study like this, and then how do we use that data. Again, we're not thinking about what's happened in the past, we're thinking about what we think is going to happen going forward. And these methods and patterns of contributions and all that, it's going to help us understand how this plan is going to react under various scenarios as we move through time. And we have this quote down at the bottom. I think it's sort of funny, predictions are difficult, especially ones about the future. It's a very true statement. We can come up with 1,000 different scenarios and it may not exactly match. It will never match exactly what's going to happen in reality. So number 5, slide 5 here, I just want to walk through a hypothetical employee and talk about how the various assumptions would affect this typical employee that we may have in the state here. So if we think of someone who's hired first at the age of 30, we know that this person's not going to just continue to work forever until retirement. There is some probability that this particular member will leave the plan. Either there are a few different ways. First, maybe through termination, they say, I don't want to work here anymore. I'm going to move somewhere else. They could become disabled. They could leave the plan in that way and start collecting a benefit if they become disabled, or they could pass away. And so those assumptions that are set, that are used during the member's working career are really the termination assumption, disability, and then the mortality. We also know that when someone gets to retirement eligibility age, that they're not always going to leave immediately. So upon first eligibility, they may not leave immediately. And so when they reach that retirement eligibility, we have various rates that will say, okay, there's a 30% probability this member may leave in this particular year, or 50% probability. And then it gets all the way up to, around age 70, 75. And then we just, assume that everyone will leave at that point. And so it's not just their retirement age, it's a set of rates that help us determine when is the most probable time at which these members will retire. Another really key input here, another key assumption is the salary scale assumption. These benefits are defined in statute and they're based upon the final average compensation of the member at the time of retirement. And so in order to figure out what that benefit that member could be eligible for, we need to project their payroll forward through time to calculate an estimate of that final average compensation. And so the salary scale assumption will play in there as well. And then finally, for this member, they've now made it to retirement. Their benefit's been calculated. The next assumption is, well, how long are they going to collect that benefit? And so that's where the mortality assumption comes into play. And so we have, as Joe will walk through, we have standard tables that are issued by the Society of Actuaries that we have some adjustments for your particular population, but those tables are going to help us plan for the length of time over which those benefits will be paid. Underlying all of this, those we can think of those as our demographic assumptions or people assumptions. Underlying a lot of that are our economic assumptions. So what is the rate at which our assets are going to return? So that's currently an assumption of 7%. What is the inflation rate going to look like going forward? And then those two items will play into what do we expect the benefit increases to look like. We know that the benefit increases are based on a formula where half is based on the CPI or the measure of inflation, and the other half is based upon the rate of return assumptions. And then finally, we've talked a lot in this room about how we amortize our unfunded liability. And we amortize our unfunded liability using what's called a level percent of pay method. And so we need to have an assumption for how total payroll will grow over time. And so that's 2.5% or 2% depending on the plan. And so that's baked into these assumptions as well. And again, the reason that we make these assumptions is that there's some future reality out there that we don't know exactly what it's going to look like. But again, we have to have some basis upon which to make a decision today. So these assumptions help us model that potential future reality, start to plan for it today so that when that plays out over time, again, we have the money in the trust to pay those benefits that are due. On slide 6, I just want to talk about the purpose of the experience study. And again, this is really important to note, this experience study is only looking at the assumptions for the defined benefit plan. And again, the reason we have the assumptions for the defined benefit plan is because there are a lot of unknowns that are out there. It's different than a defined contribution plan where you just make a contribution and then whatever the value of that amount is at the time of retirement, that's the amount of money that the member gets. With a defined benefit plan, it's not as clear or not as straightforward as the defined contribution plan. So we need to have these assumptions. And we know that the assumptions are going to change on a regular basis. We know that there's new information and changing knowledge. There could be some differences in plan design and changing patterns of retirement, termination, mortality. A lot of this could be tied to the overall economy. If things are in a bad shape, we may see people working a little bit longer because they have the job and they don't want to worry about having to go find a different job. Or if things are just going like gangbusters, maybe it would motivate people to leave and maybe do something else. And so those patterns change over time. The experience study is a regularly scheduled event, and your plan has a very strong policy of looking at these assumptions every 3 years. Really, the guideline is to look at them every 3 to 5 years, and so the fact that we're looking at them on such a regular basis really helps us keep up with those changing timelines of retirement or any changing knowledge that may come out over the years. The very general process, what we're going to do here today is make some recommendations on these assumption changes, tweaks to the assumptions, and then the board, we can discuss the assumptions, and then ultimately the board will make the final decision, and these are the board's assumptions, if you will. Any changes that are made today, we're not going to go restate the 7/125 valuation, so these will be effective for the 7/126 valuation, which affects the fiscal year 2029 contribution rate. And so that's sort of the setup there, and I'm going to pass it over to Joe to start walking through some of the results of our analysis.
Thanks, Paul. Very good. So just to give a high-level summary, starting off the top, the net impact across all the recommendations we talked about today, quite minor, and we'll show you the detail in a little while, like actual impact, the info, that kind of thing. But just for state and teachers, you can see it's around a 20 basis point increase in their contribution rate for those two groups. With state, it's mostly the salary expectations that we're adjusting there that's increasing it by the 20 basis points. And for the teachers, it's they're retiring a little sooner than previously thought, and their disability rates are a little higher than they've historically been. Now, teachers in general have very, very low disability rates. So we're not talking like, they're not, with the increase, they're not even close to what everyone else is assumed to do. But it is an increase, and you're always starting from somewhere. And so it is a slight increase there. Overall, the funded ratio, it's around 0.1. So very small impact. The items that are new is for almost all the groups. Go back up on the growth. It's okay. For almost all the groups, we are recommending a slight increase in the salary scales, like those projection out in the salaries. That's something we've been talking about in recent evaluation results. We'll show you the data on that. Correspondingly, and I do think they're tied together, the turnover for most groups is also up. And I think you can kind of tie those together because the turnover leads to trying to get more salary increases to keep them, right? These things are kind of tied together in general ways. Also, retirement for teachers specifically, and we're not saying it doubled or anything. It's a pretty small increase, but they tend to retire a little sooner than they have been historically. And then also your public safety groups have been retiring a little sooner than they have historically. Increased rates of disability, especially for first police and fire, is the bigger one there. So full details in the report. And we can can ask about any of the items. We're not going to talk in detail about every piece today. We're talking about the ones that are the most impactful. So in inflation, which is a underlying component for all the economic assumptions, one of the things the standards of practice talk about a lot is being consistent. We can't turn around and use an investment return assumption that thinks inflation is going to be 4%, and then turn around and use a salary scale assumption that thinks inflation is going to be 2%. It's like, no, wait, let's let the building block first, and then let's build on the same building block so that it's consistent. You can see it impacts the investment return assumptions, salaries, overall payroll growth, and it is half the formula, as Paul said. CPI, if you look backwards, pretty much all historical periods are at 2.5 or higher. There's really only one that's a little bit lower. Because the last 10 years has been a little abnormally high, at least for all of us in the rooms lifetime. It's the 3%. But if you look at the last 20 years and 30 years, it's pretty close to the current 2.5% assumption. On the next slide, as Paul talked about, we're really looking forward. What would be the forward-looking expectations? These are several different sources here of people whose job it is to predict these things over different time horizons. You can see the U.S. Treasury Department, that's the bond yields. So that's looking at the difference between a normal treasury bond and a TIP. and trying to estimate, okay, what does the market think a reasonable estimate of the future inflation is based on CPI? You can see what the Social Security Administration assumes going forward. And so just kind of looking just broadly across them, none of them are above 2.5, right? But most of them are really close. They're looking at, the 2.4s, a few high 2.3s. So if we look back, generally all history has been a little bit higher than 2.5. Looking forward, a lot of these sources are saying slightly lower than 2.5. I personally think we have to think about what are these using for versus what we're going to use it for. So these have very finite time horizons, right? They're saying, look, the next 5 years, the next 10 years. So if you look at history of inflation, it's low, wildfire, right? Low. And so they're looking at probabilities. They're saying, hey, the next 5 years, the next 10 years, yeah, there's a chance we could get a wildfire, but generally we're probably not, and therefore it would be lower. As a pension plan, you have to live through all the history. So there will be another wildfire. You will have to live through it. And so for that reason, we should be assuming a little higher than what these short-term sources are thinking, just to be prepared for those high periods that do eventually show up. We think the 2.5 is reasonable, and so we're recommending no change there.
Joe, quick question. Are you
Sure.
weighting this information like this, the past 10 years versus 20 versus 30? I mean, clearly the world's a different place, and last 10 years you're over 3%. Are you weighting them at all and coming up with the 2.5? I mean, because even though these are referencing below 2.5, last 10 years is a pretty solid baseline to be able to judge kind of where we are today.
But also if you look at those last 10 years, it's not like it was 3. It was 2, 1.8, 2, 1.82, 9, 2, so no, we don't have like an objective scoring system or something like that. It's professional judgment is just the way to think about it. And it's really a couple of ways, and this will be the same thing with the best return assumption. What I'm always looking at is, okay, is there a different answer that looks better than what we're doing now? Like, is there something else that looks objectively better? And if there's not, well then stability has value to itself, right? So let's just keep doing what we're doing. And I don't see any other number that I would pick that I would think, oh yeah, all the data is pointing that this is better. Okay, and so that's kind of good to know.
Thanks.
Okay. The next slide, now we're going to talk about the investment return assumptions. And so why this one is so important, because of compounding. I mean, if you've ever done the little exercises where, the 25-year-old puts $100 aside and it grows to a gazillion dollars, and the 40-year-old puts $1,000 aside and it almost does nothing, right? It's like time and compounding are so powerful. Well, that's exactly what's happening in this model, is that we're assuming 7% over time. That means 1.07 and then 1.14, like it's compounding up. And so we're going to pay $1,000 to a retiree sometime out in that future. How much can we depend on the assets to cover, and how much contribution I think to cover? And so the higher returns can be, but the lower the contributions could be, and unfortunately vice versa. And so this is the most powerful assumption, and unfortunately it is also the most subjective. It's the one that we actually, from a forward-looking perspective, have the data necessary from the last piece that doesn't tell us that much about the next 10 years. And in fact, if you pull it out in 20-year segments, you get an anti-correlation, meaning if the last 20 years were above average, your expectations probably should be that the next 20 years will be a little bit below average, and vice versa. But again, even that doesn't hold. It's not like these things just aren't. And so we want to use the best judgment we have, and then, as Paul said, set a baseline, but then let our contribution strategy work around that. So the next slide talks about how we look at this. We're going to take your target asset allocation and compare it to several sources of expectations, similar to what we did with the inflation, right? I showed you several sources, not just one. Here we're going to look at 12 or 13 sources about going forward. What are these expectations? All these are reliable sources in the fact that these would be, if the SIC was to put their investment consultant work out to bid, these are the types of firms that would be attempting to get that work. So they have economists, like they're qualified to look at these types of things. But we also look at the volatility, we also look at what you've done historically and what everyone else is thinking. Because if you think about what everyone else is doing, you kind of think about that as like a marketplace almost. It's the marketplace saying these should be assumed. So to go to the next slide to give you what that peer group looks like. This is the NASRA Fund Survey, which is about the largest 120 or so plans in the country. What are they assuming? And this is giving you the history of that. The red is what the median of the group is. If you were to line everybody up, what's the middle spot? The blue is the average. And so you can see that they do go together, but the average currently is a little bit below the median. The green is what the history of this board's assumption has been. So you can see over time, the patterns very much align. And it's been a tough decade, right? From 2009-ish down to 2021, 2022, a big change down. So again, back to the compounding example, you're taking $1 you're going to pay out 40 years from now, and now you just significantly changed how much of that dollar is going to be covered investment returns versus contributions. And so this led to a lot of increases in contribution during this time. But you can see that come 2021, and especially after 2022, when the interest rates rose back up, there really has been very little movement at the group level or the individual plan level. Like there's been very little movement in this assumption in the last few years. The next slide kind of gives you an idea of like how broad of a distribution is this. You can see 7 is used by is the most sort of the mode. We do have about the same number that are 7 1/4 as 6 3/4. But then after that, though, you can see there's only 3 left at 7 1/2 or higher. And there's 24 there that are 6 1/2 or lower. And so there's various reasons that different plans might be at different spots, but you can just see that kind of what the distribution looks like and how it is a distribution around 7%. Okay, so this is the more, we'll call it objective, but it's really a set of assumptions in itself that if we map your current target asset allocation as the SIC is set to these different sources of capital market of expectations, what are they saying would be expected for the next decade, the interim term for this plan. The SIC's investment consultant specifically gave us information that 6.7 is their current best estimate for the next decade. You can see there for all the 12 sources, if we look at the third column, that's their 50th percentile. They're saying, hey, you got a 50-50 chance of being at this level and above. You can see 7 of the 12 are above 7, and then the other one is a 698. We're going to say there's way more movement in this process than 2 basis points. So we're going to say that one is there as well. So a vast majority of them do support the 7. You can see it's around a 50-50 probability on average for the next decade. If we extend that out, a few of these sources do give us a little longer periods. Then that probability does increase to around 54%. So it's not 70% or, it's still pretty close to 50%, but it's a little higher if we can get a little bit longer time horizon on those processes. So again, we go back to our same exercise earlier, assuming 7. Is there some other data point that appears to be filling up that's better? Not really, right? It seems to be as good as any other. So the next slide, we show you this process has a lot of volatility in it. Those capital market assumptions, those investment consultants and the investment staff using them, they're trying to deal with and work in a real life market environment right in all the time. And so they need, information that's moving with the real life market environment. We're again wanting something that can set and stay stable over time. So you can see if we take the same target asset allocation and just apply it to the last 5 of our surveys, the range has gone from as low as 6.1 back in 2022 up to 7.4 in 2023. But even the average of those 5 is 7. So we're recommending no change. So going forward. All right, so turnover is the demographic assumption that's having the biggest impact, and almost pretty sure all the groups, well, state police and judges, we basically don't assume turnover because they have almost none. But for all the other groups, we are increasing the turnover a little bit. You can see here, this is for the teachers. The way to read the graph is this is the probability that a teacher would leave service in the next year. Or, another way to think about it is if you had 100 teachers with 1 year of service, we would expect around 17% of those 700 to leave next year. You can see that the line is what's actually happened. That's the actual data for the last decade. The blue was our previous assumption. You can see it tracks in a very similar way, right? It's a very similar pattern. They clearly are aligned in some way, but that the whites are regularly above the blue, right? I mean, it's all the way across the board that they are a little higher. So we are moving the assumption up into close to what that actual has been. If you run somebody all the way through the pattern on the previous assumption, we would assumed around 49% of new hire teachers make it to retirement. The new assumption is 46%. So a very modest change, but it does lower the liabilities because now we're saying of everyone we hire, fewer of them will make it to retirement than we were.
Joe, is there an impact regarding lower contributions because you're having newer employees?
You could, and so this type of size of change is not going to move that needle very much. Also, we just have an assumed payroll growth, which is kind of a round number, 2.5%. If we were to, and we do have a few models where we do this. If instead we didn't have a fixed payroll growth rate assumption, but we were just using what the model was projecting how payroll changed, then it would change it a little bit. But usually this is how it's done.
Okay.
The only reasons we've used it, those other approaches in other cases, is when they have like maybe we have a situation where tier 1 group uses overtime for contribution and tier 2 doesn't. Well, now we're talking gigantic changes in pay, and so I need to be able to reflect that over time. But in this case, no, but it's a great question because it could.
But in response to that question, increased turnover, at least in the near term, would result in an increase in employer contributions to the extent that, relative to liability, to the extent that a greater percentage of the employer contribution represents paying down the unfunded liability. We have retirees who would be accumulating little or no actual retirement benefit or lesser retirement benefits. So the liability incurred for those employees would be less, but we'd still be contributing an employer contribution
On the replacement employee, right? So the big if with your with that statement is okay, if more people leave than expected, then the employer contribution could go down if they're not replaced, but they should be replaced. We're assuming they're replaced. And so hopefully your payroll base therefore is not impacted that much, but it could be a little lower if it's turnover quicker because people that leave are replaced by people generally at a lower pay scale type of a situation. But it does lower liabilities because especially, and it's not those people in the first few years of their career, but that 10-year teacher, we're currently expecting, a lot of those 10-year teachers to make it to retirement. And so now if we're assuming 5 less of those make it to retirement, that's a significant difference in liability projection. And that's true across all the different groups.
It's also a less of a benefit when they do start to collect.
Oh, absolutely. The individual levels way level. It's liability. And so I think the response to this turnover situation is one of the reasons you've seen across all of our clients, salaries are up. And this is where professional judgment starts to show up as well. It's like, well, wait a minute. Yes, the last 5 years have been very high, but is that our best estimate going forward? Is this some sort of an acute situation, or is this a difference in pattern? We've historically used 10 years for this analysis, but because of these recent numbers have been so high that even over a 10-year period, it blows the averages up significantly. But also, I think especially for police and fire units, I don't see any reason to think that we're gonna just immediately in the next 2 or 3 years go back to some historical low. Like I think, there's gonna continue to be pretty high. So we do have lots of data for you. So we pulled 20 years patterns and kind of see what is this long-term trend and make sure that we are not underestimating that trend, but that we're also not overreacting. One of the things we want to make sure in all of our assumptions that we're not setting up a situation where we run to this side of the table, this experience study, and the next experience study, we're running back over to the other side of the table. We want consistency. So you can see here, this,
Joe.
yeah, go ahead.
I just want to make a comment, being in the corporate world for many years. You normally don't see it coming down. Once it goes up. You can almost guarantee, and you can't guarantee everything, but I've seen it in the corporate world, increase over time period, just stays or continually grows.
It's very sticky, right?
Right.
That's
Just
the expectation, and then now you're disappointed when you get something that 5 years ago you've been very happy with.
Yeah.
And now all of a sudden, well, this is a lot lower than what I've been getting, right?
The worst thing that happens, at least in the corporate world, is that they start cutting people
Right.
over increase, but the increase is still maintained.
So the way this chart, the line you're seeing is if we hired somebody at $40,000 pay, and then what would be their pay at different points in time throughout their career. And this is using the average patterns in the last 40 years, would be the white dashes. And so over that whole time horizon would be about a 5.5% increase over their career. So that doesn't mean the across the board for 5.5. It takes everything into account: merit, promotions, everything that could be built in is built in. And you can see that we were currently assuming around 5.2. It's one of those situations where, wait a minute, if the last 20 years has been a little higher than we're currently assuming based on the stickiness conversations, we probably need to get up at least to be 20, which is good. And so we've done that here. On the next slide, you can see for most of the groups, we've taken a similar stance. But what we're also not doing is trying to perfectly fit to some recent past, because again, we don't want to be running over here, running over there type of a situation. And also because where you are in a funding pattern, the contributions are already pretty high. The next 10 years, we really just need to continue to collect those dollars to get the unfunded liability paid off. So you can see all the groups except teachers. We did go up some. MERS general seems to be up a little, but not near as much as the others. So state police, the 847 there in the actual experience fits right into we're going to talk about it in mortality, where if you get an outlier. So the state police is not, they didn't get 88888. Like they had one kind of update, like they had 1 year that was a big increase, that was kind of an update. So we really should be careful thinking, well, then that giant increase is going to happen again into the regular pattern, right? It's probably more of a one-off type of situation. And so that's why here you can see we did go up because the rest of the pattern also was up, but don't think that, oh, why are we still, assuming 3% less pay than what's actually happening? It's really a one-off event. And there's no way state police could get an average 8.5%. But eventually everyone would work for the state police. No one else would do anything else. But this was the impact. This was the one change across the board that increased rates the most, for example, for state police, state employees. If this would be the only thing that happens, if everything else was quiet, we just looked at state employees, it would have been about a 70 basis point increase on their contribution. Okay, so mortality. Now we did have a pandemic during this period, and again, we're trying to look forward. This is the crude rate for male non-teachers. And so what crude rate means is just across the board. How many retirees did we have? How many of them passed? Just a straight up percentage. There's nothing too complicated about it. But it should be, as you can see here, pretty consistent. Now, this is where also credibility starts to show up. You're not that large of a group. I mean, I know compared to where you live and your existence, the state is a large group. But statistically, it's not that. Right. So for example, Texas Teachers is one of my clients. we have 6,000 retirees pass every year. So if I do this same chart for them, it's like every year's perfect. It's like, don't. Like, there's almost no volatility. It's very stable because they're so big. Well, in your case, you're not small. Like, for example, if we did the same exercise for just city of Warwick, it'd be all over the place, right? So you can see a lot of stability here. It's generally between 3 and 3.8%, 3.38%. But we do have these 2 years where during the pandemic, it was significantly higher. Those were about 3 standard deviation events. And so as we go through the analysis, we decided, take those 2 years out and add in 2015 and 16 to get us back. We like to have 9 years. The way the process works, we kind of need an odd number of years to wait to get so we can have a central point. But I also like to use a lot of data. I don't want to use just 3 years of data because again, you'll be swinging around. I'm trying to get as much data as I can. And so we did throw those 2 years out of the analysis.
Point of order on this. You indicate that 20 and 21 were not counted, and you counted 15, 16.
During a subcommittee discussion, there was a lot of going back and forth because, as you said, it was an outlier. I did an analysis going back to the first study in 2010, which included in the previous 3 years another pandemic. And looking at these numbers and looking at Pub 2016, which you cite, they discounted 2020. So you're looking at mortality for essentially a 6-year period, but you're only counting 3. You're discounting the pandemic, which I think had a much larger impact if we apply this. And I'm just looking at the data and your study itself, you cite the pub and you're saying, oh, it's been updated, but we didn't discount it. Or we did discount it. It was updated in May of last year. And my question is, why wasn't that data included in this study? I'll just leave it at that. You're looking at a 6-year study.
I don't know what you're asking.
You're looking at a 6-year study. It will be the study of record.
Well, it's a 9 years.
Well,
we don't use it.
This publication is going to be valid for 6 years, okay?
3 years.
Well, looking forward 3 years, but it covers a 6-year period overall.
It includes all history that we decided.
No, you didn't. You just, up here, you said you discounted 21 and 22. Pub 2016, which you cite and was updated last May, also discounted 2020. So you're looking at 3 years of data that we're throwing away. And you're only counting 3 that you substituted. My argument is that's not credible. It's not an actual experience.
Okay, their 2020 is on a calendar year basis. Y'all's fiscal 21 is going to overlap with that with 6 years. So that's not some other year. That's the 2021 on the sheet. The reason they haven't got to 2022 yet is because it's not in pub, it's not included in pub 16.
No, I understand that, but you're saying 20, I understand it's a calendar year. If that's fiscal year.
2016 is the central point of that study. They did not have the data from 22, 23, and 24 yet to include it.
Oh, I understand. No, what I'm saying, Joe, is
What
you're
we're looking at is a 3 standard deviation event that if we included the average would raise our mortality expectations forever by about 5%.
but that's
So we would
actual.
be funding to about 1 year less expected lifetime based on including those 2 years. So we would be underfunding the plan by about by a significant amount if we include those 2 years, and that makes no sense.
It's actually 3 years, Joe, because their pub said they discounted prior to June of 2020, which would have been fiscal year 2020.
Okay, let's look
So
at
you're
this,
discounting
which basically
21, 22, and 20. And your data is based upon, even though the outlier is there, you're saying, hey, this is actual experience. My contention, it's not. It's 3 years were discarded.
All right, so
Now
you're
let's look at the
saying
next-
what you're looking for is the actual experience. That is not the purpose of the experience study.
Your first
Purpose
slide
experience
4
is to
says
set
actual experience.
The experience studies process, the entire purpose is to set forward-looking assumptions. It's not to say what the previous experience was as a perfect number. What we're trying to do is say, what is a reasonable thing to use for making decisions going forward? So let's go to the next slide, which proves our entire point without even, it's not even close. So we go to the next slide. Plus, there's an entire occupation, it's called actuary.
And that's from Pub 2016.
Okay, it's way harder than that.
Forward slide.
Okay, we have standards of practice, and there's lots of history of how to do statistical analysis. And this is clearly a situation where you would not include those 2 years in the middle of your statistical analysis of trying to show a forward-looking expectation. So let's look at the male. So this is a static outcome from the study. So let's look at other employees male. So for a 65-year-old, how much longer do we expect this individual to live? And this is based on the actual data from those years that we did include, again, not the 2 years from COVID. So the current assumption is we would expect that group of males to live 19.64 years. That was set last experience study, which again didn't include the 1 year of COVID at the time, but it used all the years up to that. So that was the historical norm expectation, 1964. Throwing those 2 years out, our actual data has come in at 1968. So we're going to statistically say that is a match. That is right on. And so, yes, we're updating to Pub 16, but that's mostly just changing the dates because we take your data and we do adjust it based on what's actually happening with you. So yes, we start with the baseline, but then your data generally is a little higher than the baseline. And so we have statistical approaches to adjust for that, which we've always done. And so we had a 2010 base national table that we made adjustments to. Now we have a 2016 national table that we made these similar adjustments to, and they get us back to the same point. And that's why you can see here almost no change between the previous assumption and the current one because your actual data is coming in right in line.
But once again, slide 4 of this presentation said it's based upon actual experience.
It didn't
And
use
as
that as an input. And then we used
You
professional judgment.
discounted,
We discounted the pandemic of the last 100 years.
so you're saying the first one counted,
What first one? There was
the first
there was
experience
pandemic
study in
the
2000.
Spanish flu pandemic. And
No,
then
no,
was-
sir.
So why would we? assume it's gonna be another
In
one?
2009, 2010, there was a swine flu pandemic,
Okay. And
which
how much
should have been
higher was-
included.
how much
in the
higher was
first
mortality?
study.
How much higher was mortality?
I don't know, you get paid for doing that. My point is, you keep saying actual experience, you're saying your mortality is based upon actual experience, when in fact it's not. And as I said, Pub 2016 was updated last May. That's almost a year ago, and you make note of that, but you didn't include that data in this report. And I'm just gonna leave it at that.
My best that you leave it at that. Okay, so now that's static, that's based on data right now. In the assumption, again, we're building out how long will people live? Historically, longevity has improved. And so what we do in the actual model is build in improvements in that longevity going forward. So what you see here is that 1964, 1967 from the previous slide. For a 65-year-old, we're actually going to model is around 21.1 on the next slide, because it builds in that by the time this 65-year-old 75, the mortality is going to be a little bit better. By the time they're 85, it's a little bit better. And so you can see that a 65-year-old in 2036, we're going to assume lives a little bit longer. A 65-year-old in 2046 lives a little bit longer. The scale that we use to do this part of the process is the same scale Social Security uses. It's kind of just a normal long-term pattern of how improvement has occurred. We're not making any over generous or conservative assumptions on this one. You could have 20 demographers come in here and explain to you why mortality would be different in different ways going forward. And we don't want to get in that game, right? We just want a nice stable assumption that we're going to work off of, and then when actual experience shows up, we'll react to it at that.
So just one quick follow-up, so I understand the technical debate that both of you are having, is actuals at 1968. Your proposed is 1967, right?
Right.
So ultimately, it comes down to what? Liability we're showing and contribution.
Right.
So what is the actual impact going to 1967 versus 1968?
Wouldn't even round to a basis.
Wouldn't even round it.
Yeah.
Okay, so that's why you're presenting it such as an irrelevant point.
Right.
Okay, I just wanted to make sure.
Well, and we use,
understood.
so we don't want to overfit, right? So like when we make adjustments to the table. To get it exactly, we'd have to use, okay, we're gonna use 110.146 of the table, like,
Yeah.
no, we're gonna use 110% of the table, like, we're not gonna fit over.
So that's no problem. Thanks.
Because it doesn't. So anyway, so this is built in, so the impact. This is for state and teachers, so state employees. It has about a 14 basis point increase to the normal cost to the value of the benefit being earned. Between the two, between the different changes, and for state employees, it's almost all just salary going up and turnover coming back down. On the unfunded liability, $6 million total change, funded ratio 0.1%. So very modest impact here. By the time we actually get to the valuation, right, there's always pluses and minuses, assets, different things. This is not even gonna feel like you're not gonna notice. Our normal up and down is more than this. Now what we do show here is we went ahead and projected out, go back one slide there. We tried to project out what we expect this upcoming valuation to do. Because even though, yes, this is saying because of the assumption set, we should get a little bit of a bump in contribution rates. However, over here to the right, we'll show you what actual 2028 rate is. Basically, we're expecting the rate to go down a little bit coming into this next year already. And in fact, we're expecting them to go down by around 40 basis points for the state employees. So this would be expected to cut that in half. So basically, instead of going down 40, probably go down around 20. Estimate. For teachers, they currently are putting in 2516 and 2028. Our old assumption set expected that to go down to 2498, so about a 20 basis point decline. With the new assumptions, they'd be back at 2519, and so net should be around a 3 basis point increase in rates. So again, we're not expecting much plus or minus currently. Now, if the course of the investment performance continues to be good for the rest of the year, it can be more than this and that kind of stuff. But you can just kind of see where we're currently see these results. Overall, it's very, very modest impact. On the MERS General is actually getting a little bit of a decline. They also have a little now here because we don't have as easily a updatable projection for these groups. We didn't do 2029, but we would expect that they would be getting a little bit of relief similar to the state employees in this upcoming evaluation already. So this should add to that. Now, MERS Police and Fire, this was the one that did have a bit of an increase, but that's also the one, if you look at the recent experience, the recent valuation results have had more trends to contribution rate increases. And it's generally because, yes, their turnover is up, but their salaries are up significantly, their disabilities have been up. They seem to be retiring a little earlier. And so that one does have a little bit more impact, 1.19% increase. They also, though, because they're well funded, they have a lot of assets. Get a good another 6 weeks here, they're probably going to have a significant positive coming from asset performance. But we have some deferred gains that they still need to come in, so they could easily have half of this offset for the investment. And again, we don't change assumptions. We don't say, oh, well, if it changes the contribution rates, we're not changing the assumptions. Like, no, we're not in that game. But it is important to understand what is the impact, and that way lawyers can begin to prepare and to set expectations. All right. So in summary, very minimal impact across the board except MERS Police and Fire. It has no change to the trajectory. If we were to update the full projection for state and teachers, you wouldn't even see the difference on the line on the page or the time frame for getting to 75% funded. The full detail, including impact to all the groups, state police, judges, and everyone is in the report. And what we think generally would be that this basically said, hey, the current assumption set has been reliable. The contribution amounts that have been going in have been appropriate. Here's a couple of tweaks to make it a little bit better for what's currently happening, but overall, very, very minor impact. So are there any questions about these? Yes, ma'am.
I'm sitting here and I'm listening to all of this, and I've come to the conclusion, you are doing your job. You're doing it very well. But I've come to the same conclusion, or to another conclusion, that we as a board are not doing our job. Because according to state law, our primary fiduciary responsibility are to our members. Our members are never mentioned once how this has affected them. So to me, to do an appropriate actuarial report or projection or whatever, we have to include the beneficiaries and the retirees who are receiving this money. To me, this report is very incomplete. We've got figures that are accurate, but we have 60,000 members, and we are totally ignoring the effect that this is having on them. And I had expressed to Andrew, I would like to see, as part of your report, how this has impacted our members.
So this report has no impact to the members.
Right, but I mean, that's what I'm saying.
Like it has no,
We
it
should.
has no. Well, no, because all this is doing is Paul got into, all this is doing is setting the assumption set that this board wants to use in determining the employer's contribution rate. Because the employer is responsible to pay for the member's benefit. That member's benefit has nothing to do with this process.
Okay.
That member's benefit is set in statute. There's formulas, right? For a retiree, their amount is already set, and if they're gonna get increases in the future, that's based on a formula. That formula has nothing to do with any of the assumptions that we talked
So
about.
these assumptions are based entirely on employer.
This entire process is
contribution.
just to make sure those employers are putting enough in to cover what's owed to the members. So by changing any of these assumptions, it would have no impact to what any individual member gets.
Right.
Now, unless, let's say we were too aggressive, let's say the board was like, oh no, we want to lower these contribution rates. So we chose some assumptions that were too aggressive. So we're not putting enough money in. Well, now we're putting risk on the members, right? Because they're not putting enough money in. So we want to make sure that the member benefits are protected by making sure the assumptions are as reliable as we can.
But according to your original projection, which you had noted, based upon 2011.
Right.
The Retirement Employee Security Act. The employers would discontinue contributing at a certain point, or discontinue current rates of contributions as of the end of the projection. That does impact the members.
Sure, it could, but that, again, this report we're talking about today does not impact that pattern or that reality.
Right, and I have another question for you. You mentioned that at age 65, a male is expected to have an additional 19-year lifespan. In 2011, many of the retirees were right around that age, 65. And so the whole projection was based upon the fact that they would no longer be there in the 20 years that the projection covers. So it seems to me there are some flaws. And again, I understand what you're saying, and as I said to initiate this, you are doing your job. But I feel as the board, we should be asking more. And I believe that you are the ones who can provide that information if you were requested to do so.
Could I maybe make a clarification at the staff level? So I think you're raising some important things, but we also have had some regular, I think, points of miscommunication on this.
Okay.
So this is a very kind of narrow and specific task that sets kind of the rules for how they'll do the next valuation. And the fact that it's called the experience study doesn't mean it's supposed to accountants like all of our experience of life. It's a narrow technical task we're setting to be able to conduct the next valuation. And so I think it has to have some limited scope. There's a second issue, which is, whether you like or don't like the current laws. The laws say there's an amortization period over which the previous accrued liability is paid. That is not tied in any way to mortality rate. It's not set by this. That's a separate law. If you, budget office wants to clarify me here. A separate law sets the number of years on which we're paying off that previous unfunded liability. And so that is, again, totally separate from what we're setting as contribution rates for future benefits. And so many of the things you're interested in, I'm happy to help provide you, but I just want to explain that it's not in the narrow scope of this report, because this report we're mandated to do on a small set of issues.
Okay, can I ask this then? Will there be an additional report which gives us the information on how this has affected our members?
So,
I mean, we sit here as a board and we talk numbers. And we talk numbers and this chart is correct and that chart is correct. But in the meantime, we are here for our ERSRI members. We never mention them. Well, we do sometimes, but, and again, it seems wrong to me. There seems to be something missing here. And I'm wondering if I could maybe request that we have such a study done, which indicates the impact on the people who are part of this system, who are paying into it. The people, our members are, we are paying into the system. Yes, the employers are paying it. That's one aspect. The employees are making significant contributions and we are ignoring how that is impacting them. And again, I find no fault with the numbers that have been given. I just want to feel that we are having a more complete analysis.
I will offer now, and I've offered again, to meet with you to fully understand what you would like in that report. I think that would probably be a qualitative report of how people are experiencing system. That might be a different thing than an actuarial report, but I'm happy to
But then
investigate that.
who would do that? I did present you with information. For example, if someone had retired at $50,000, that person, as of right now, would have lost from their personal income over $200,000. One individual. That is something we cannot ignore. And I gave you the figures for if someone had been earning 40 and 30. I just want some sort of verification that no, we are not forgetting our members.
So can you meet with her?
Yeah.
Advocacy with me.
Yes,
But it doesn't just involve me. I want this to involve all of us.
I would support your request. I think that's a very interesting study. I think board should take, have this report studied. Doesn't matter, Joe's doing it, who does it. But I think that's important topic.
and I just, Patrick, feel free if you want to weigh in here. So yes, I've offered to learn more about what you want here many times. I'm offering again. I do that. I'm happy to do this. I do want to say, as a board, there's something that is over the top of our rules and regulations, and it's the law, right? And so these benefits are set by law, and we're measuring that. Is that correct, Patrick?
Correct,
So we don't have the discretion to just use the board's funds to study anything we want to.
No, I'm citing the law. It is number, right here, 36(8)(4.1) state law. Which indicates very clearly we are acting solely in the interest of participants and beneficiaries. And yes, we have to maintain the fund, obviously, because that would not be in their best interest. But in the meantime, we have to take them into consideration, or we're just sitting here not a
So-
yes to reports that really are not significant.
So,
To our,
so we'll sidebar after this, and then I just want to move the meeting
Okay.
on, because it's people that.
Right.
have
With
to get back
with
to work.
regard to the report and methodology.
Yeah.
The subcommittee met last Friday. In anticipation of that meeting, because I'm old and I can't read that well on a computer screen, I asked for a hard copy. And Mr. Roos was very kind and produced it to me. I spent the next 3 days reading it. And I want to point out, I checked convene at 1300 on Monday, 1 o'clock for civilians. And the agenda supporting documentation was not posted. It was posted at 1500 on Monday, 3 o'clock. And my question is, how do we expect the board to essentially look at this report, digest it between 1500 on Monday and 0930 today, and actually vote in an informed manner on that, okay? As Sandra has pointed out, we're looking at the impact on members of the system. And I have data from the general treasurer's website, what the value of the fund was on 28th February. Pre-war was 13.156 billion. But the issue is, I'm looking at this report and our unfunded liability has actually increased. If you look at that number and the expected performance, you would have, after paying all benefits, a surplus of 1.6 billion. This is after the paying the 1.1 billion in benefits from the state, from the employees and the investment return. And my question is, and I know it's going to be reflected in June, but we're forward looking. And these numbers, I don't make these numbers up. This is from the general treasurer. So my question is, how can we make an informed decision when you've had less than 48 hours to digest this? And are we to blindly accept the presentation on the screen without not having the opportunity to understand this? Okay.
So I think we're getting off topic. I'll let you go, and then I'm gonna have to count.
Yeah, so I just wanted to make a comment about the due diligence on this report for the rest of the board's benefit. The administrative committee met last week, reviewed this, the full report and a presentation from the actuaries. We had it in advance of that meeting. We asked many questions, including Mr. Palazzo asked many questions at that meeting. I also see that the presentation is a little bit different than the last presentation we received in some specific ways that address the questions that we asked. So to say that we're blindly approving this, I don't agree with that statement.
And not the subcommittee members who were informed, the other members on this board and the, what I see.
So I said I was gonna make one point here, and I would defer to legal counsel on this. So we have on the agenda that we may vote this.
No, you have on the agenda to approve it.
We have that we may vote on that.
No, you have approved.
That's
It
the
would be-
recommendation.
To ask for recommendation of the judge. When we come to that point, which Gene would give us, if the board were to feel that it did not have sufficient time to review, I think it would be fine to vote it next month. I would like to clarify that in some previous years, we've done this without even going to the admin committee. It's come straight to the board. In some years, I look back, I believe the plan before I was hired was to maybe review this in a training, not an open session, and we decided to do an open session, so we could have open session admin and open session here. But it would be very reasonable if someone were then to make a vote saying, if anyone here says, you know what, I would like to sit on this information longer, we could table and vote it next month. That'd be a very reasonable thing for someone to ask, if that is the feeling of the board.
I have more comments after Mr.
I mean,
McBride.
that would be, anyone can make any motion they want, obviously, and that could be approved. But just make the comment, you do have the admin committee, it kind of gives you the first step, similar to how we did it with the governance committee. Through your hiring process, the entire board relied upon the expertise of the governance committee and their recommendations in that process. I liken that to this situation where you have it go to the admin committee, they conduct a thorough review at that level and then make their recommendations. You consider that recommendation in conjunction with the presentation today and the report, should you have had time to review it before today.
And I do like that process of going to the admin committee because it gives it much more time to review, much more of a focused approach. And then I trust the members of that committee to recommend the best possible report to the full board. So
Okay,
yeah, one
well,
more question because I'm gonna pass it.
I just want to make a statement,
Yeah.
point of order. I have submitted to the general treasurer and the director notes and comments that I've compiled going through this report. I've asked that they be included on advice of counsel. There will be a reference, however, they will be available for any members of the board to review them. My question essentially is, investment successes are applied to employer contributions. And I look at that, I take it with a grain of salt, because after 15 years of investments and religiously following the ARC, our unfunded liability has actually gone up. We're at 4.4 billion. After 15 years, some people are paying extra money into that system. And while seems to be focused on the employer, as Sandra has pointed out, where are the members of the system? There are, and I know go around with the defined benefit versus defined contribution. 2/3 of the members of this system are in the defined contribution plan. 2/3 retirees and actives. However, they're not addressed anywhere. And I know it's not under the charter, but maybe we need to look regarding actual experience for them. The formula is never reported to the members, not that I know of. And there are a lot of questions that I get from active members of the system. Where do they stand? As I said, 2/3 are defined contribution. It's not even addressed anywhere. And that's my point. As I said, my data is there. Some of it has been submitted to the House and Senate Finance Committees based on state information. There's also data points. The surplus available to this fund based on this data as of 28 February, after all benefits paid, is 1.6 billion. So how does the unfunded liability go up? And I'll leave it at that. I just want, as I said, my notes are going to be available to all members of this committee. And I think it's disingenuous to say, hey, the subcommittee, I'm not sure if the entire subcommittee looked at the 68-page report and the information available to them.
I did.
Okay, that's
Good.
two.
So wanna give it to Gene for his recommendation to the full board.
So question, please,
Sure.
for Joe.
Sure.
Okay, I appreciate you look at the expense for for this assumption study. You talking about investment and administrative expense, the two of in our state. Of the 120 of the public pension fund, where are the face our state is are we where we are? And
Oh, like how,
yeah,
from the, here.
yeah, it's this page, your property page 61, I think.
So so we're assuming administrative, so let's separate them. So administrative expenses, which is running the system, you know, the payroll people here, is around 10 basis points of payroll that is covered. So take all the payroll for all the active employees, is around 10 basis points to run out an administrative basis. I don't have the data in front of me, but I do know compared to my other clients, that is on the low end of the range. That a lot of mine I know are as much as 30 basis points. Even some of my big plans are 15 to 20. So that's a very efficient number. And I can work to get you some more data on that. It's more than just off the top of my head. So that's on the administrative side. On the investment expenses side, I don't know if I have enough information to give you that. What we assume is that the investment performance will pay for those investment expenses. And so that the 7% is after all investment expenses are paid. And so probably would have to get that from the SIC. That way they can outline that for you. You can see where all the different, because unfortunately on the admin expense side, it's pretty uniform. Like if I take you and then I look at, you know, if we did Massachusetts and whatever, probably pretty close to what's in the administrative bucket to be able to compare. On the investment side, it can be a lot broader of how they classify things, like where do you put private equity bonuses, where do you put like all the different components, how does that all fit to investment expense. So we probably get that from them, but I can try to find more expectations. But just to answer the question today, your administrative expense is quite low compared to my other clients.
Yeah, because it's very interesting. We were, my under impression, the fund is I don't know, investment fund. The fee was. I was just want to hear your opinion. Is that reasonable to be, you know, at this size and compared to national all the public funds? I think that's something.
Now, our assumption on that, I mean, I've seen people try to add the investment expense in directly and try to pay for that. I've always been on the opinion that you as the administrative board, we as the actuary should not be trying to influence policy on the investment side of how they would do their work, right? And so I always take it as if they were just purely passive, like literally, you didn't even have a CIO, like you just invested it how Fidelity's random generic thing would tell you to do it. That's ground zero. And so anything past that is active management at some point, right? And so what I've always assumed is that if those active management expenses are not at least paying for themselves, then you would stop doing it. Right? Like if they're not at least paying for themselves, then you would go back to the Fidelity generic passive only situation. And so that's how I've always because if we were to go in and put a negative in and say, hey, you know, we're going to make the employers put in an extra amount to try to pay for those investment expenses. Well, now we could potentially be influencing how the investments are made because maybe, you know, that investment group would get pressure to change how they do their investment expenses all of a sudden. If that makes sense. Like we don't want to be influencing one way or the other what they think their best ways of investing are. But what my opinion on it is that over time, it's going to bear itself out. And if they're not paying for themselves, they'll stop doing that and those expenses will go away.
I agree. We shouldn't be, you know, if you hire somebody invested,
Right.
you shouldn't be telling what to do. But I think it's important as a board, we watch for the pay. This is part of our retirement fund. So it's very important as you evaluating. I was just trying to say, if you can further give us a report in your opinion compared to all the public fund, although our fee is reasonable or where we stand. I think that would be interesting for my
try to get you some.
Yeah, and that's part of the reason why in the last several years we've convened the two boards so that SIC understands what ERSRI is doing and vice versa. We'll get to understand, you know, investment returns, but they also understand why you chose the assumed rate as you did today, or will be doing today. So we'll have that hopefully later this year where we can move both groups. But I'll pass it on to Gene, please.
Thank you, Treasurer. On Friday, May 15th, the Administration Audit Risk and Compliance Committees met in public meeting. And based on the presentations and discussions with GRS, we voted to accept the recommendations in the actuarial experience study. Having said that, I'll call for a motion to accept the recommendation of the Administration Audit Risk and Compliance Committee to accept the actuarial experience study as presented by GRS.
Motion by Gene, second by
Second.
Mary. All in favor?
Aye.
Any nays?
Nay.
Nay. Two nays?
Nay.
3 nays. Got that, Roxanne?
Yeah.
He approved, it was second.
I did.
Bill Murray.
Oh, Marie, thank you.
Thank you. All right, I will now seek the approval of the April 2026 pensions as presented by ERSRI. May I have a motion? So moved by Jean,
Second.
second by Bill, all in favor?
Aye.
Aye. So, any nays? No nays, so moved. Thank you. We will now move on to the committee reports. We'll first hear from the Disability Committee. Doctor?
Sorry.
We're actually, that was going to do council first.
What do we want to do?
Ah, I already said it. Go ahead.
Okay. All right, so I'll make a motion to approve the disability committee recommendations from our May 1st, 2026 meeting.
So move.
Move. Second,
Second.
all in favor?
Aye.
Any nays? No nays, so moved.
Thank you.
Thank you. All right,
So I'll be
so I skipped legal, sorry.
That's fine. I'll be brief. You have the updates in the packet. I'll point out one of the updates, which is the David Wells case. He was a firefighter whose accidental disability retirement was denied by the board. He filed the appeal in Superior Court. Judge Rika Sloan dismissed his complaint for lack of subject matter jurisdiction. When you take this decision, also in conjunction with a recent Supreme Court decision in an O'Connell case, which was kind of the inverse, where someone filed inappropriately in workers' comp court, we're starting to get some good case law regarding venue for police and fire, which is they have to go to workers' comp court. They cannot go to Superior Court. So I just thought that was interesting, should be noted. I also note for the board that when we do send out the denials, there is a one-page pamphlet that's included that says police and fire should file in workers' comp court. Apparently, Mr. Wills disregarded that notice. But just wanted to point that out, that we're starting to get some good case law around that.
Thank you.
Define good case law.
Well, case law that clarifies.
Good for who?
No, just that it clarifies where you're supposed to go.
I just wanted you to clarify the meaning behind good case law, because that seems to be a little subjective at times, so I appreciate that.
Just a question, when I was mayor, we had a case that we won in the court. And they took it to Superior Court. Is that how it works?
So if there's a workers' compensation, if there's an appeal that goes to workers' compensation court, either party can appeal that decision to the workers' comp appellate board. If either side has an unfavorable decision at the workers' comp appellate board, then it goes by writ of certiorari to the Supreme Court.
That's what happened. Okay, just check.
All right, back to committee reports, the Admin Audit Risk and Compliance Committee, Jean.
Thank you. Once again, on Friday, May 15th, the Administration Audit Risk and Compliance Committee met in a public meeting. And based on staff recommendation and discussion, we voted to recommend for 1 year the ERSRI contract. If Andrew can provide some details.
Great. A basis of the discussion is that this was a contract signed previously. It's a somewhat larger dollar amount, but we're not obligated to send all that mail. So at any point, the Member Services Committee or the Governance Committee will decide we wanted to send fewer mailings, we could spend less. So that is for the total amount as budgeted. It's primarily postage. I do think, for the conversation today, that coming in as a new director, I would like to do some planning. We're in the middle of strategic planning as a whole Treasury and as a retirement department. We should think about what services and information we want to provide. And so it's very appropriate to RFP next year when we have had an opportunity to do that planning and have a better sense of what it is we'd be asking of vendors. And I appreciated the admins committee confidence that we could go through that process. So this is just for 1 year in a natural extension.
Having said that, I would call for a motion to accept the recommendation of the committee for the 1 year extension of E-Way contract, ERSRI Communications and Website Management in the amount of $462,829.
So moved.
Second.
On favor?
Aye.
Any nays? Move. Election Committee.
We're doing that work on
I
that.
know.
He's a busy man.
On Wednesday, April 29th, the election committee in a public meeting to discuss a special election to replace Claire Newell as a representative of active state employees. The committee reviewed the election materials prepared by the staff. The committee certified 3 candidates for election. The committee administered a lottery for ballot order. And Andrew Andrew, if I can turn it over to you.
Great, so there's no vote or steps need to be taken here today. The election is ongoing, the ballots have been printed. We are hopeful that if there's not a very strange outcome like a recount or a tie, then we would have a member for the next meeting. But we, followed the previous processes and rules. As we always do, we changed the process to rolling a dice rather than choosing a name out of a hat because we thought it would be better randomization. I would like to thank Heidi and Roxanne who continue to push the process forward every day.
Good. Next questions for Andrew? I'm good. Good, all right. I'll seek a motion to adjourn.
Second.
Second, all in favor?
Aye.
Aye. Meeting has adjourned. Thank you.
Thank you.
Yeah, of course.